In this video, I'm going to demonstrate an easy to follow mean reversion trading strategy which uses no indicators. Here's what the equity curve looks like for the backtest over the past 16.5 years. I'm going to show you the exact entry and the exit rules for this strategy. But most of this video is going to be me going through the step-by-step process which I used to build the strategy in the first place, in case you want to start building strategies for yourself. I'm going to show you two separate versions of this strategy in the end. One of them which is the regular one, and then one which has a modified exit, which brings the win rate for the strategy up to over 80%. Firstly, we're going to look at the strategy rules, look at the entries, exits, and talk about why I decided to test what I tested. Editing Jared here. Just quickly, if you don't want to watch a 20-minute video of me showing you how I developed this strategy, then you can skip to about the 15-minute 30 mark where I show you the final entry and exit rules. But if you are interested in the development process, then please keep watching. Next, we're going to take 3 separate versions of the baseline strategy and test them across 28 pairs. The purpose of this is to try and find some stability and robustness. Once we've found some positive performance, we can then dive deeper into that individual strategy, refining it, including looking at changing the exits, adding stop loss, etc. And up until this point, all of the testing has been done on a large sample of in-sample data. If and when we're happy with the final strategy, we can then go ahead and test it on some unseen or out-of-sample data. And in this case, that out-of-sample data is 2.5 years of the most recent data. And then finally, we can apply the modified exit to see what impact that has on the strategy performance. So let me show you how the strategy works, and then we're going to have a look at that initial testing. Okay, let's look at the trade entries. We're going to be using a 1440-minute chart or a daily chart, and I'm using a custom session, which I'll explain more in just a moment. So rule number 1, if the close, so we're just looking at closing prices here, if the close is the highest close over the last X amount of bars, then sell short next open. And the opposite is for buy trades if the close is the lowest close over the last X bars, buy next bar at open. Now I mentioned I'm using a custom session. I'm using TradeStation data, and normally the closing bar is at 16:59 Eastern Standard Time, and then the open is a minute later at 1700. However, I've adjusted this and I've got my closing price at 1650, which isn't going to make hardly any difference whatsoever, that 10 minutes. But I've got the open price at 1830, which is 90 minutes after the standard open. Now I've done this because in live trading, that's going to allow us to avoid some of the high spreads around the open of the session. In the backtest, if I was using 1830 or the regular open at 1700, it wouldn't make too much difference on this strategy. But I thought I'd like to just include the reason behind that. Trade exits, very simple. The main one we're going to be using is the stop and reverse. And what that means is if we're already in a long trade, so we've bought, the only way we're going to get out of the trade, well, for 2 reasons. We're going to get out if we get stopped out, but mainly we're going to get out when we get an entry signal to go short. So we're going to exit our long position, and then reverse it, and then go short, and vice versa when we're already in a short position. Number 2 is the optional bailout, or first profitable close exit. What that means is we look at the end of the day or the end of the session, and to see if we're in profit or not. If we're in profit, then we exit, we bail out, we take the profit and end the trade. If we're not, we just leave the trade running, and then we check 24 hours later to see if we're in profit or not, and then the same rules apply. However, I have actually included an extra rule here, which is only employ this bailout exit after we've been in the trade for at least 5 bars or 5 days in this case. The only reason this is there is because I was doing some testing with this strategy on some smaller bar sizes, like a 4-hour bar, and I wanted to include a rule for the bailout exit to make sure that we're in a trade for a minimum duration, and I used 5 bars and I just rolled that over into this daily strategy. But in testing, whether we use 2 bars, 5 bars, 7 bars, it's not going to make too much difference, so don't worry too much about that. And that bailout exit increases the win rate typically. So the initial testing on the 28 Forex pairs, we're going to be looking at that X bar look back length, so the close over X amount of bars. And I've broken it down into 3 separate ranges. We've got a range of 3 to 7 days, which is roughly a week, 10 to 20 days, which is roughly 2 to 4 weeks, and 21 to 60 days, which is roughly 1 to 3 months. Now, the initial testing, rather than test every day within that range, I've just gone in the middle. So for the first test, I'm going to be using 5 days, then 15 days, and then 45 days. I know 45 days isn't in the middle of 21 to 60, it's roughly in the middle, and it's a multiple of 3. So we started off with 5, multiply that by 3 is 15, multiply that by 3, and that gives us our 45 days. That's why I've chosen these 3 initial lengths to test. Just a quick trade example. I know I said this is a no indicator strategy, which it is. However, sometimes indicators like Donchian channels can make spotting the trade easier if you're not automating your trading like I do. So I've just got like a Donchian channel on the price there, showing the highest close and the lowest close over, I think in this case it was maybe 10 bars. And I've highlighted in yellow those closes. So looking at the first one here, you can see this was the highest close over the last X amount of bars, let's say 10 bars, I think it was. And then we initiated a short trade on the next open. Then we've got the lowest close, and then we exit our short trade, and then we entered a buy trade on the next open. Okay, and you can see those whenever the close breaks that channel, showing the highest and the lowest closes. So really, really simple signals. And later on, we're going to be talking about a stop loss, which is just as simple. I'm going to run 3 separate tests using those 3 different look-back lengths across the 28 Forex pairs. I can do that quickly using Multicharts' Portfolio Trader, and I'll show you that in just a second. But what I had to consider was the data which I'm going to take from the test results. The backtest is going to provide lots of different information, including net profit, equity curves, that sort of thing. I'm looking for a robust strategy, so in this case, I'm going to try and find some Forex pairs which show positive performance across all 3 of the look-back lengths. This isn't essential for a strategy, but in this case, for this strategy, that's what I'm looking for. The next question is, how do I judge positive performance? I could quite easily just looked at net profit, but I'm going to be testing across 15 years of data, and we could potentially have a strategy which performed terribly, losing money for, let's say, 12 years, but then had outperformed for that last 3 years or a particular 3 years, showing high net profit, and that would have passed. But that's not what I'm looking for. What I'm looking for is consistency and stability, essentially a nice smooth uptrending equity curve. Equity curve then would be a good judge of performance, but that's typically visual and can be a little bit subjective. So to keep things simple, all I did was look at the number of positive years over that 15-year test period. So let me show you the tests and let me show you how I collected that data. This is the Portfolio Trader part of Multicharts. Multicharts is the charting trading software which I'm using. And at the moment I'm running this on a VPS, and that's provided by Trading FX VPS. A VPS, or a virtual private server, is just a cloud-based computer. They're handy because you can conveniently run things for 24 hours a day without interruptions, which definitely helps when you automate your trading like I do. I've been doing a lot of optimizations lately, and which can take a while. Having them running on the cloud rather than my local computer or my local home laptop is great. I'm pleased to say that this VPS from Trading FX VPS has performed really well. So if you are thinking about getting a VPS for yourself, then I can definitely recommend them. I'll leave the link to their website down below. And they've also given me a discount code too. So if you want that, which can change from time to time, just send me a quick email and ask me what the current discount code is. I'll leave my email down below too. So looking at the Portfolio Trader here, we can see on the left-hand side the list of the 28 Forex pairs which we're testing. On the strategy, we can see that we're looking at a look back of 45, so that's the one we've tested. I'll just show you, run a quick optimization, and this shows you all of the 28 pairs. And then if we click inside one of the pair, we're looking at the annual period analysis. So we can see how much profit was made for each of those 15 years. And all I'm doing is I'm counting the amount of profitable years. And I did that for each of the 28 Forex pairs. I mentioned that we can quickly do these tests, so if I change this to a look back length of 5, which was the first one we're testing, run the back test, and this is our list using that look back of 5. So we can see, for example, euro pound using a look back of 5 gave us 10 profitable years out of those 15 years we tested. The test data, by the way, I've mentioned it's TradeStation, and we're looking from January 2008 through to January 2023. That's our 15 years. So to collect this data, what I've done is I've used a spreadsheet. And let me show you that. I've put all that data in this spreadsheet, which I call a heat map. I just thought it was a good visual way of understanding where some of the strengths are and some of the weaknesses are within these 28 Forex pairs. And what I've done, just through conditional formatting on the spreadsheet, is I've highlighted in green any of the lengths and the pairs which have 10 or more profitable years. And then the others are all in red. And I mentioned at the start of the video that I'm looking for this test, I'm looking for some pairs which perform on each of the 3 different lengths. And we can see that we only have one of those pairs, and that is euro pound. You see that? 10, 12 and 10 years across the 3 look back lengths. There are a few others which perform on 2 of the lengths, and like Australian Swiss franc here, and even on the 45 days, the 3rd test, 8 out of the 15 years, so not far off. But I think this is quite a good way of visually understanding which pairs respond well to this type of strategy. So from these results, I'm going to select euro pound moving forward, and now we're going to go over into multi-charts and dive deeper into refining this strategy. Now we're in multi-charts, we're specifically looking just at euro pound. We're still looking at the same date range from 2008 through to 2023, but this time I've included 6 pips worth of trading costs. I'll just show you that. In the previous test I didn't include trading costs, but now we've got £30 each way, so £30 in, £30 out, a total of £60. We're trading 100,000 units here, which is one full lot, and £60 is equivalent to 6 pips. Now, instead of testing those 3 look-back periods of 5, 15 and 45 days, this time I want to run a complete test covering the whole range. So from the lower end of the first range, so 3 days, through to the upper end of the longest range, so 60. So I've run an optimization from 3 bars through to 60 bars. And let's see what that looks like. Here we can see my look back. This is the look back length, 3 through to 60 bars. And if we look at a 2D graph, this is a graph showing us net profit. So the look back length is along the bottom here, and initially what I saw was some instability perhaps through these earlier look back or these shorter look back lengths, but what I did notice was that the longer look backs seemed to be a little bit more stable. Anything from kind of 35, 40 through to 60 was quite a stable area. So we need to make a choice, so I just chose somewhere in the middle, and I chose a look back length of 50. So let's select 50. And if we look at the performance report, we can see that now we have 11 profitable years. But what does the equity curve look like? There's the equity curve, which I think is pretty nice, pretty consistent. I'm quite happy with that. Looking at the average trade value, got a huge average trade of £813. That's even after costs. So it's an average trade of 81 pips. Percent profitable is 68% profitable. The next thing I want to do though is include a stop loss. So let's run a test on the stop loss value. Going to keep the look back at 50, and we're going to run a test on the stop loss between £1,000 and £4,000. That's equivalent to 100 to 400 pips in steps of 250 or 25 pips. So let's run that optimization, and let's look at the graph. Looking at the results for that stop loss, it seems that possibly a lower stop loss here from say 100, 125, 150 pips is not very good. Net profit then jumps up, but then after that it seems to be reasonably stable. So again, I'm just going to choose something in the middle. We're going to use 250. So let's select 250 pips. And straight away we can see that the average trade has gone down quite considerably. Stop losses do tend to hurt the performance of these types of reversal strategy. And there's the equity curve. So it hasn't really destroyed the equity curve, which I'm pleased about. So essentially, I'm quite happy with the performance of this strategy. So using our look back length of 50 and our 250 pip stop loss, I'm quite happy that that looks reasonably robust, and I'd like to test this in some out of sample or some unseen data now. Next, we're going to check this strategy which we've developed, but this time on the 2.5 years of out of sample or the unseen data, to try and give us an indication of whether we've over-optimized or curve-fitted this strategy. And then if and when we're happy with that, we're going to adjust the exit to that bailout exit to see what effect that has on the performance. But just before we do that, if you like this type of strategy and you're looking for more ideas for rule-based trading strategies, then you'll probably like my 22-page Beat the Market Strategy Guidebook. In there I'll give you 3 more strategies, all laid out with the rules for the entries, the exits, the stop losses, to give you some more ideas. If you find the link in the description, you can download that absolutely free. So the last charts we're going to look at include the out of sample data. So this chart we've got from January 2023, which is when our in-sample data stopped, through to June 2025. We're using our look back length of 50 and our 250 pip stop loss, which we already determined. There's what the equity curve looks like, which is nice. It's uptrending, pleased about that. And the average trade value is slightly higher, £730, and we've got a percent profitable of nearly 89% in this out of sample period. I've also included the out of sample data with the in sample data. So in this chart, this shows us from 2008, the start of the in sample, right the way through to June 2025. So all the data. I've actually got the bailout exit on there. I'm going to remove that just for a second. So we look at the baseline strategy. And here's the baseline. Average trade £559, percent profitable 66. And there's the equity curve, including this last part, which we just saw on its own. So I'm very pleased that the out of sample data, that almost 2.5 years, is in line with the rest of the strategy performance. I'm happy that what we've done seems to have worked. Well, it's definitely worked in that out of sample period. And the last thing, let's just switch on that bailout exit. I can do that easily because I've included that in the code. Here you can see that we've got some bailout exits. We're in the trades for a much shorter length of time, in the market as a whole for a shorter length of time. There's what the equity curve looks like with a bailout exit, and it actually worked pretty horribly in those early years. It wasn't until about 2011 which actually started working reasonably consistently. It has worked very well recently though. The bailout exit gives us a much lower average trade because we're not in the trade very long, but it does increase our percent profitable or our accuracy. So it's an option which we can use. Well, it's nice to see that that original edge we found while doing the initial testing is still working, or certainly working, in that unseen or out of sample data. Typically, if we had over-optimized on that large in-sample data which we were developing on, then it would show up in the equity curve. We would have a nice uptrending equity curve in the in-sample development data, and then when applied to the out-of-sample data, it would just continually go downhill. But it's not only over-optimizing, curve fitting, or just bad strategy development which causes a strategy to fail, or causes the equity curve to go downhill. I've seen some really basic edges in the Forex markets work for years and years, and then those edges just disappear, both slowly and quite abruptly. Sometimes the market behaviour can and does change, and that's why it's so important to monitor the performance of each individual strategy which you're trading. Try and identify when that edge in the market starts to disappear, or certainly when your strategy's performance starts to decline, so then you can think about switching it off. Anyway, I shall continue to watch this strategy for another 6 months or so, and then consider trading it live. Well, that about concludes this video. As always, I hope you've enjoyed it, and I hope you've learned something. Thanks for staying to the end, and if you'd like to see more videos like this and you haven't already, then please consider subscribing. I hope to see you next time, but until then, this is Jared Goodwin, and thank you.